when popular American radio broadcaster Arthur Godfrey said, "I'm proud to be paying taxes to the US. The only thing is, I could be just as proud for half the money." I couldn't agree more. Yes, paying taxes is my and your civic duty, but wouldn't you rather keep more money of your earnings in your pocket rather than give them to the IRS? Now, what if I told you with a strategic tax planning, you can actually save tremendously on your tax bill? Like, subscribe, and because I'm about to share tax planning tips that will keep your finances in tip-top shape for 2024. So starting with number one, max out your employer's retirement plan. Now, the whole point of tax planning is to reduce your tax bill while still staying compliant. You want to save money, but you don't want to get in trouble with the IRS. Now, the first thing and the easiest way to do this is to maximize the retirement plan offered by your workplace. Here, I'm talking about 401ks, 403bs, or 457s. These retirement plans are tax deferred, which basically means that your contributions and deducted from your pre-tax income. So essentially, you're getting a tax deduction today and lowering your tax bill today. Now, let's take an example of a 401k. The maximum deductible contribution limit for a single filer in 2024 is $23,000. Now, assuming you make $70,000 this year, if you make the maximum contribution to your 401k, then your taxable income will be $47,000 instead of $70,000. This is what is known as tax efficient investing. So you definitely want to take full advantage of this by maxing out your contributions. The best part is if your employers offer a match, which basically means they can contribute $1 for every dollar you put into your 401k. Maximizing your contributions means you're exploiting that benefit too. But remember, tax deferred doesn't mean tax free. I want to stress that. Once you retire at 59 and a half and start making withdrawals, which you must, by the way, from age 72, whether you need the money or not, you're going to pay taxes based on the times rate. Still, tax deferred plans means that you get more money to invest and grow tax free for decades. Number two is put some money into your IRA or Roth IRA. As your income increases, $23,000 may start to feel like too little of a contribution towards your retirement. And the question now is, what do I do with the rest of the extra income that I make? To make the most out of the tax benefits IRS offers, you should definitely open an IRA or a Roth IRA. Now, let's start with the IRA, also known as a traditional IRA. This works more or less like a 401k. In other words, it's tax deferred. Since not all employers have 401ks, an IRA stands as a great alternative, and anyone earning an income can open one. Beyond the tax benefits, an IRA may actually offer you more investment options than the 401k, which is great for asset diversity. Currently, the contribution limits for the IRA are $7,000 if you're under 50 and $8,000 if you're over 50 and trying to catch up. On the other hand, the Roth IRA works a little differently from the 401k and IRA. Instead of pre-tax dollars, you contribute after-tax income into the Roth IRA. Then that money grows tax-free until retirement. When you get the withdrawal, it is also tax-free. But be warned that an Roth IRA comes with income limits. If you're earning anything over $161,000 or $240,000 married jointly filely, so you don't qualify. So what open an IRA doesn't make sense. A Roth IRA is a great idea when you're in your early years in your career, as you meet the eligibility requirements. Two, if your income has dipped lately, which means your tax rate has also gone down, then you can consider a Roth IRA. Lastly, this plan also makes sense when you're anticipating an income tax rate increase in the future. Having the 401k, IRA, and Roth IRA will no doubt increase your retirement savings and potentially reduce your tax bill significantly. Number three is consider Roth conversions to avoid higher taxes in the future. Now, did you know that a major tax rate debate is expected to happen in Congress in 2025? Yes, most of the 2017 Tax Cuts and Jobs Act will expire soon, and we should expect higher taxes as the government targets a whopping 3.4 trillion more in net taxes. The most effective will be high income earners and businesses. As you already know, an IRA is a tax deferred, which means you'll pay taxes when you start withdrawing at retirement based on that time's tax rate. So if your retirement isn't too far off, you might want to consider converting your IRA savings into a Roth IRA. This way you'll pay taxes at the current rate as opposed to the higher tax rates you can expect if you retire or do the conversions in 2026. That said, it's not just the rising taxes you have to worry about this year. If you're set for a raise that could put you in a higher income tax bracket, a Roth conversion might also be a good idea for you. Number 4 is open a health savings account. If there's a deal as good if not better than a 401k, it is the health savings account, which is why I recommend you include it in your 2024 tax plan. Apart from allowing you to save up to $4,150 as an individual or $8,300 as a family, your money gets to grow tax-free, and here it is, you get to withdraw it for qualified medical expenses, also tax-free. But before we get ahead of ourselves, what is the HSA and why do you even need it when you already have health insurance? Well, while health insurance does cover many medical and surgical procedures and costs, most providers don't cover everything. In many cases, you still will have to foot some part of the bill depending on the agreement. This is where the HSA comes in. It helps cover some of these medical expenses not covered by your health insurance. We're talking about things like your dental care, eyeglasses and contacts, psychiatric care, prescription meds, and coinsurance and copays. So instead of paying for medical expenses out of pocket with after-tax money, consider contributing to a HSA if your health plan qualifies you to reduce your taxable income for 2024. And your money gets to grow while you're not using it as well. Number 5 is take advantage of the QBI deduction. Up to this point, I've mainly talked about planning your earned income, usually from employment. So let's talk about a tax strategy for business income. The QBI deduction, also known as the Qualified Business Income Deduction, is a tax provision where qualified business owners can deduct up to 20% of their net business income from their taxable income, effectively reducing the tax bill. So if your profit for the year is, let's say, $100,000, then you can deduct $20,000, which means that only $80,000 will be taxed. If you're a sole proprietor, that puts you in the 22% tax bracket without the deduction, and you save $6,400 in taxes. So the big question is, how do you qualify? You only need to be a pass-through business entity. That includes sole proprietorships, partnerships, S corporations, and limited liability companies. Number 6 is seize the available tax deductions. Did you know that you can deduct your mortgage interest from your taxable income? If you're never consider itemizing your deductions, it's time you added this strategy to your 2024 tax plan. That's because standard deductions have increased by $750 from 2023 for single filers to stand at $14,600 and $1,500 for married filing jointly to reach $29,200. Apart from mortgage interest, you can also deduct medical and dental expenses paid out of pocket, losses from theft, and even charitable donations. Number 7 is review your estate tax plan. With tax laws set to be revised come 2025, this also is the year to revisit your estate tax plan. Remember, the 2027 job tax cuts at double the amount you could give or donate from your estate without owing the IRS. In 2024, that limit is $18,000. So if gifting appreciated assets in your estate to say your children is a part of your long-term plan, you want to accelerate that in 2024. Number 8 is don't forget about tax loss harvesting. Investing is not always rosy. Sometimes you make a profit, other times you have to contend with losses. Now, if you put some money in assets outside of your retirement accounts, you want to consider tax loss harvesting as a way to reduce your tax bill this year and offset some of your losses. So how does this work exactly? If you have an asset that has lost value, and you decide to dispose of it at a loss, you can deduct that loss from gains earned from other investments to reduce your capital gains tax. If the loss is greater than that, you can use it to claim as much as $3,000 in deductions from ordinary income. Now, the best part is unclaimed losses can be carried forward to the next tax year and the next indefinitely. So, over to you. What tax strategies have you included in your tax plan for 2024? Let me know in the comments, and if you love this video, like, share, and subscribe for more. Till next time.